raise your hand in the middle or type into the chat box. Feel free to go ahead. Um, and with that, Ryan, I'm going to turn it over to you.
All right. Well, thank you, and thanks to everyone that's joining, and we're going to be doing a recorded session here, so anyone who didn't get a chance to dial in today will get an opportunity to listen to this. But today we're going to talk about a review of the third quarter, and then just a brief market outlook into 2022. A lot of different things have happened over the course of this year and really the past almost 2 years now. And so we're going to review the effects of some of those things on the market, review some uncertainty moving forward and seeing how things are going to shape up, and then just really talk about some data points and as well as share some insights on what investors can do moving forward to prepare themselves for the rest of this year and beyond. So we always like to start with a little lighthearted quote or a cartoon, and so this one was one that we found funny, but basically saying, "A little kid playing with a yo-yo, please stop. It reminds me too much of the markets." And I think that's what many people probably experienced really over the course of the past 18 months, but more so when we talk about the third quarter. Um, One of the things that we saw in the third quarter of 2021 was that at the end of it, we kind of ended up where we started. So, U.S. markets finished on shaky ground. So, what we saw throughout the course of the quarter and different asset class performances is that for the most part, most asset classes, with the exception of a few there on the left side of the screen, were in pretty much neutral or negative territory. We saw commodities on one end did have a pretty good spurt of growth, and then emerging market stocks on the other end saw a pretty significant downturn. But you can see off to the right, year to date, many of the asset classes, or a majority of them, have finished in positive or are finishing in positive territory as of today. However, what we saw in the third quarter wasn't necessarily the same experience that you may have had over the first half of the year. So what happened? As far as the S&P 500 or the representation of the US stock market is concerned, we saw continued growth in July and August. So as you can see there on the right side of the chart, we saw price appreciation in the S&P 500, and in some cases to all-time levels. But what ended up happening in September is we saw a pretty significant pullback. A few different reasons why, which we'll get into here in a minute, but ultimately what that led to was a great experience the first couple months, and then a September that was a little rocky, and that led many investors to question, what does the rest of this year look like? So one of the things that we saw in the month of September, which caused, I guess, investor confidence to wane some, is that we saw I guess you could call it a spike in 10-year Treasury yields. So the yield on the 10-year Treasury was up above 1.5%. As you could see, for the first time over the course of this year, it was a pretty drastic spike. In comparison to this graph, as far as interest rates are concerned in general, still relatively low, but the creeping of that 10-year yield is something that ultimately led markets to start to sell off a bit, and we saw a little bit of a pullback in the S&P 500 and other sectors of the market. So, what were some of the key trends that we saw during the third quarter? Number one, strong corporate earnings. Two, decelerating economic growth. And three, a potential shift in monetary policy. So, some things that we've heard from the Federal Reserve moving forward and how they're going to handle monetary policy. So, for strong corporate earnings, this graph is a representation of earnings per share, or earnings growth year over year in different quarters. So, as you can see, from Q1 to Q2, we saw a pretty substantial increase in corporate earnings. So this was actually the highest rate year over year since the fourth quarter of 2009, which was when we were coming out of the economic crisis. Um, a pretty substantial number. A lot of different things factoring into that corporate growth. Obviously, massive policy with fiscal stimulus from coronavirus relief programs, some additional reopening of the economy, a gradual reopening, I should say. But corporate earnings, for the most part, were pretty resilient, even with the emergence of some other factors, things like the Delta variant of COVID-19. Q3 and 4 much more conservative estimates showing as far as corporate earnings, but just something to keep an eye on, as we move forward. But all in all, some of that growth that we saw in July and August ultimately were driven by earnings numbers coming out of some of the largest corporations in the U.S. Decelerating economic growth. So like I just mentioned, economic reopening was paused. It's hard to believe, but still at this point in the pandemic, we're still talking about potential for more reopening and economic expansion due to reopening. So there was some slowing due to the Delta variant in various areas of the country. That also caused things and some things that have led to decelerating economic growth or supply chain bottlenecks. So most people are probably aware at this point that various industries have been affected negatively by issues with the supply chain. So getting goods delivered to the United States, being able to convert those goods or the raw materials into goods has slowed down a lot of parts of the economy and has caused some inflation in various areas. Automobiles is one that many people are familiar with. But as we trickle into the holiday season, that's something that we're going to be keeping a closer eye on to see how is that ultimately going to affect corporate earnings. Because if a supply chain bottleneck does not allow corporation, obviously, to get the goods that they turn around and sell to consumers, that's going to slow growth in earnings for Q4 and beyond. Another factor contributing is the Chinese economy continuing to slow. So, one of the largest economies in the world. Part of the reason, additional regulatory crackdowns. And then also there was a concern about the default of Evergrande, which is a pretty large property development or real estate development company in China that saw a pretty drastic drop off, a 99% reduction in their stock price at one point. So concerns about that default, less demand for different goods just due to economic slowing and fears of potentially dipping into a recession are all things that in a global economy or a world that relies on a global economy, I should say, things that were of concern to investors in September. Something else that has come to light through listening in to Federal Reserve meetings are that they're expected to start tapering asset purchases in possibly November or December. Ultimately, what that means is that they're going to stop buying bonds in the market, which ultimately leads to a reduction in liquidity. There was also conversation about potentially increasing interest rates sooner than expected. So initial discussions on the front end of the pandemic were possibly 2023 or 24. Now they're considering starting spiking, I shouldn't say spiking, but raising interest rates towards the end of 2022. So those are some things that are going to be in the back of the minds of investors moving forward, and those are some things to keep an eye on, as we look through the fourth quarter of this year into 2022. So this is really a visual representation when we talk about Federal Reserve and monetary policy, how they tend to handle things like tapering, making purchases, and then ultimately the interest rate hikes that follow. So as you can see on the left side, stemming back to 2010, there were some asset purchases and Federal Reserve held securities. You see tapering, net purchases go to zero, and then shortly after, we see that stepping of interest rates that start to climb from 0.5% all the way up to 2.5%. On the right side of the graph, we can see that there was a spike in Federal Reserve purchases. That was on the front end of the pandemic. That has continued to grow, but as the Fed continues to taper and net purchases creep back towards that zero that net zero number, what we're going to see is on the bottom part of this graph, those interest rate steps are going to start going back up at some point and ultimately get closer to the Federal Reserve's target rate. So what can we expect moving forward? What does the market look like going into 2022? So some of the driving forces are going to be economic growth and expectations around that. So economic growth, for the most part, is expected to remain robust. There's a lot of different reasons why, which we can dive into, but a couple other factors to consider are healthy consumer balance sheets, savings rates, net worth in the United States has grown during the pandemic, believe it or not. And so pent up demand and readily available cash is something that many economists believe will help continue to prop up economic growth and allow that to continue well into 2022. Low interest rates should also to continue to support markets, even though we've seen a rising rate, especially on the 10-year Treasury yield. Um, the idea that interest rates are still relatively low from a historical perspective is something that we want to keep in the back of our mind when we talk about what's going to happen in the markets. So expected economic growth, we can see annual GDP growth in 2020 down for obvious reasons with the pandemic, but the estimated for 2021 is close to the 6% number, and it's believed that into 2022 that GDP will be around 3.8%, almost 4%, which is a pretty good number in comparison to what you could see from years past. So all in all, we were not just we, but other economists around the country believe that economic growth um, will still exist in 2022. We will see growth in GDP, and that's something that I think ultimately will trickle down and allow investors to remain confident about investing in the stock market. The second factor is healthy consumer balance sheets. So, U.S. household wealth and debt payments, you can see that crossover point there in 2013, but ultimately what we've seen throughout the pandemic and also disposable income, it's increased over the past year, or let's call it 18 months. One of the reasons, obviously, massive fiscal stimulus, economic disaster loans, PPP, as well as for the everyday consumer stimulus payments. What we also saw was that many households significantly increased their savings rate over the past year or year and a half throughout the pandemic. So you can see that number in December of 2019, the savings rate for U.S. households was 7%. That has increased to 17% since April of 2020. Why is that significant? That tells us that many U.S. households and many consumers have cash available to spend. And so when the economy does continue to reopen and possibly fully open when we get into 2022, there's going to be a massive pent up demand. And we're also going to see things like additional consumer spending, and some of that money may even make its way into the market, which ultimately can drive prices up there. So the third factor, low interest rates. Something that we believe will continue to support markets. You can see the historical rate on the 10-year Treasury yield compared to obviously rates in the 80s and 90s up until today. We're still at a historic low when we talk about interest rates. Because of that, we feel like money is cheap. Abilities to purchase things like homes, vehicles, to finance certain purchases in the market today are significantly easier than they used to be, and cheaper. So cheap money always, not always, but it tends to lead to economic growth. We believe that that's going to continue to help prop up the markets moving forward. And until rates start to rise more significantly, we believe that the markets are going to react favorably to the current interest rate environment. So to summarize everything that we just talked about, strong economic growth, a healthy consumer, and low interest rates typically are a formula for a positive drop back for stock markets. So moving forward, we believe that there's still some a positive outlook in the market as a whole. But more importantly, we're going to get into what can investors do, and some of the things that we traditionally talk about in these presentations may sound like a broken record, but ultimately it still rings true, historically speaking. And we'll talk about some of the reasons that many are using as indicators to potentially get out of the market. Maybe a reason to actually stick it out and stay invested for the long term. So one of the things that we want to watch, or a few factors we want to watch moving forward: the resilience of corporate earnings. Will that continue beyond this year and beyond the massive fiscal stimulus that we're seeing and the money pumped into the economy? Rising inflation is certainly a concern. Many believe that it's transitory. However, some inflation that exists currently has stuck around longer than many economists ever thought it would. So the question is, what will go away? What is truly transitory, and what is here to stay? And then ultimately, fiscal policy uncertainty. So through COVID-19 relief initiatives, we saw a massive pumping of fiscal stimulus into the U.S. economy. Beyond 2021 and into 2022, what will that look like? What legislation will be passed? There's potential tax law changes on the docket. There's a lot of uncertainty around what will that look like in 2022 and beyond. There's a concern about the debt ceiling more recently. So there's a lot at play there. Not a lot that we can say for certain, but some things that we're going to want to watch moving forward and keep a close eye on when talking about how investors should be positioned in their portfolios. So I talked about resilience of corporate earnings. We saw that spike from Q1 to Q2, but the estimates moving forward aren't going to be as drastic. So we're not going to see that 91% year over year growth. We may see more conservative, still good, but still more conservative than some of the than the first half of the year of 28% and 22%. So we're seeing sharp increases. What we are looking for is to see how resilient will corporate earnings be going into the end of this year, especially with some of those challenges that we talked about with supply chain issues, potential inflation on goods and other services, and how is that going to trickle down ultimately to investors. Rising inflation is another piece. As I mentioned, many people agree that most of the inflation that exists today is relatively transitory, meaning that it's temporary in the sense that we believe that once supply chain issues work themselves out, some things will normalize. Other industries are not seeing that same return to normalcy. So, for example, the automobile industry expects that inflation, the inability to get things like microchips, delays in production, and moving out that cycle of getting new inventory is probably going to be expected to last for them for about another 12 to 18 months. So some inflation, while it may be transitory, there are other things that are going to stick around for a little while. And so it'll be important to pay attention to that and see how does that ultimately affect the markets as inflation continues to rise. Will that transition to corporations potentially increasing prices? Will their cost of doing business or their cost of goods and services remain high? And then how does that trickle down to the investor? Does that keep earnings strong? Do they raise prices to maintain earnings, or does that cut into profit margins and ultimately trickle down to investors in a negative way? Fiscal policy uncertainty. So as you can see on the right side of that graph, fiscal stimulus as a percent of GDP, you could see various points in time. Obviously, recessions of 2000 to 2002, we saw a pretty significant, even more significant after the financial crisis in 2008, and even more significant than that when we talk about 2020 and the coronavirus pandemic. So as you could see, those are pretty big numbers on the right side of that of that chart. The question is, are we going to be subject to some form of fiscal cliff in the sense that we have this massive fiscal stimulus? Will it continue, or will that drop off significantly? And without knowing what policy is going to be moving forward with various legislation that's being introduced, infrastructure bill, will it get passed? At what level? What will be available in terms of money to spend there? How are they going to raise funds to pay for it? So tax law changes. Like I mentioned before, a lot at play there, a lot of things to consider, and things that are going to be developing really on a weekly basis, and something that we're going to keep a close eye on. So with all of that information and all the things that have happened, and what we can expect moving forward, the natural question is, what can we do? Ultimately, we like I said, may sound like a broken record, but we tell investors, stay focused on the fundamentals. Ultimately, financial planning and investing happen in a long-term lens. And so what I mean by that is that your financial plan, while you experience things from year to year, ultimately should be focused on what are your goals? What's the end goal? What's the end result? Where do we want to be in 3, 5, 10 years and beyond? Some of the factors that we've talked about here today could be temporary in nature. Some factors that we talked about here today could have some staying power. So things like rising interest rates are on the horizon. How much and when we're uncertain about. Like we just talked about, fiscal policy, how much and when. So that question really applies to a lot. What we ultimately believe is that investors should keep their eye on the prize, so to speak. So every experience is different, every goal is different, and every portfolio is different. And we love this chart. This is something we use in pretty much all of our presentations. But this is from JP Morgan Guides to the Markets, and this shows intra-year declines of the S&P 500. So you can see there, the bars across the screen, a lot of positive returns when we talk about end of the year. So the average over the lifespan of this chart is that in that 41-year period that's depicted, the average intra-year drop is 14.3% of annual returns. And ultimately, we end up positive, and you could see a majority of those years. So how this plays out is that in any given year, in any given month, and as we saw over the past quarter, any given quarter, we can see a decline or a flattening of rate of return. Is that an indication that the year as a whole is going poorly? Absolutely not. So these are some things that we like to focus on when we talk to investors and when we talk to clients about, keeping focus on larger periods of time. We understand that the experience in the moment may be a little uncomfortable, but ultimately we want to keep our eye on the prize and focus on what our long-term objectives are. Diversification is another key and another fundamental that we focus pretty heavily on. Why is that? So this chart is a fantastic depiction of different asset classes. So over on the right side of the screen, we have commodities, REITs, value stocks, growth stock, large, small, a diversified portfolio of 60-40, high yield bonds, emerging markets, investment grade bonds. Really what this shows us, if you look at the top line, there are some areas of the market that perform pretty consistently towards the I'd say the upper half of this graph, but ultimately we can't predict when that's going to happen and who the winner is going to be. So for example, a typical investor behavior works like this. At the end of 2020, we see that commodities, and really, if we look at this chart, if we look at that bottom row, commodities have been in last place or a loser. I mean, kind of say that in jest, but they're a loser most of the time. Sometimes significantly bigger than other asset classes. So if we looked at commodities from, let's say, 2012 up until last year, that really wasn't a great asset class to be in. So many investors, what their experience might look like is, this hasn't performed well, this fund has a poor rating. If I look at, historical performance, I'm not going to invest in that at all. I'm going to scrap that and move on. The problem is that year to date, that asset class is up 29%. So what we're saying is we don't necessarily want to put all our eggs in that basket and look at what it's done previously and anticipate that it's going to be the number one winner in terms of asset class performance. But if we diversify ourselves across multiple asset classes, we don't have to pick a winner. Ultimately, what will happen is that parts of our portfolio will do really well, parts of our portfolio won't. But if we have balance across the board, then we can, and balance is relative to risk tolerance as well. So risk tolerance is different for everybody. But ultimately, if we can maintain balance and maintain diversification, picking the winners and losers when we talk about investing in different asset classes is not something that we have to be good at. Um, Inevitably, what happens is that when you have a well diversified portfolio, we're always going to have to apologize for something. There's always going to be things that do really, really well, and there's always going to be things that underperform the rest of the market. Because we can't predict this and because we ultimately can't time this, maintaining some level of diversification is key. And that's ultimately what's going to lead you to success and having a more consistent rate of return over time. This chart is something that we've just added, which is probably one of my favorites. And so the ultimate principle that we're talking about here is tuning out the noise. And so what this chart shows is the price appreciation of the S&P 500 coming out of, or the total return coming out of the economic crisis in 2008 and 2009. And so as you can see, where we start on that chart versus where we finish is pretty drastic. Upwards of 500% in appreciation. And all along the way, these red dots represent some news story, some part of the news cycle, some reason that an investor could rationalize selling their position in that index. So one that, some that many are familiar with, we have government shutdowns, we have the pandemic, obviously fastest bear market ever, happening in 21 days. We see big declines at the end of 2018, for example, pretty sharp decline there after a government shutdown. We have an inverted yield curve. All of these things are indicators, traditional indicators, where in the back of our minds we say, you turn on the news, you turn on financial media, and they talk about these things. And ultimately, what that does is plant a seed to react to that news. And so when investors see things like tapering, like, so if we go back here to 2013, this mention of taper tantrum, similar to what's happening today is the Federal Reserve, the monetary policy looks similar in that they're starting to taper in terms of buying credit securities. So when that happens, we see a downturn, an initial downturn in the stock market. What ends up happening long term, we could see that peak to trough, it works out pretty well for the investor that kind of stays the course and understands what their long term objective is. At any point in time, if you were to get out of the market for any of these events and wait any significant period to get back in, the detriment to your ultimate rate of return would be pretty significant compared to riding it out, sticking it out, and again, back to my original point, keeping your eye on the prize. So tuning out the noise is probably outside of strategic asset allocation on the last slide. So this slide, when we talk about diversification, tuning out the noise and investor behavior, again, is one of the most important factors to investor success long term. Understanding your investment portfolio, understanding the purpose that it serves for you, and ultimately not paying attention to what CNBC or any other financial news network is saying, or what anyone else in your life might be telling you about what that you can expect from the market. At the end of the day, this chart represents plenty of opportunity over a pretty significant period of time. It gives you plenty of opportunity and plenty of reasons why you may have wanted to get out of the market. But what you can see is that the trend still rings true, that where we started and where we finished is a pretty significant gain over time. So with that, we're going to open it to questions. And
Awesome. Thanks, Ryan. There was a
yep,
question. So as we look at inflation concerns, what is the likelihood of stagflation into the coming year, and how does the Great Resignation factor into this now?
those are all great questions. Are all great questions built into one. So let's see here. Likelihood of stagflation. Um, it's hard to say. To be honest with you, I think there's mixed opinions on that. It's something that gets thrown out there quite a bit, especially with some of the analysts that we work with or follow along with and listen to. I think that the reason people aren't talking more about it is that there are many economists out there that still believe that the inflation we're experiencing today is temporary. Not in everything, but for the most part, what we're seeing and feeling as of right now, there's an answer to it. There's a lack of, there's supply chain issue. There's a lack of resources. You mentioned high unemployment. Economic growth has slowed. It's decelerated slightly, but it hasn't slowed down to the rate that I think we're necessarily in I would call stagflation territory. So, there's three legs of that stool. You want significantly decreasing economic growth, really high inflation, and really high unemployment, all sustained for a period of time. Right now, that last thing that I just mentioned, the sustaining that, is really the variable that's missing. And it's, to be quite frank, it's uncertain. I mean, we really don't know. And the answer that most have to that question is I'm not really sure, because I think a lot of people, and you talked about, um, the Great Resignation, and I think when we talk about the workforce and people walking away from it or demanding higher wages, demanding better benefits, being more selective about their job choices, that's all going to come to a head at some point. Um, I think that more people want different things than maybe they wanted at the start of the pandemic. So a lot of things were brought to the surface because of that. Working virtually, something that many companies didn't do. I would say the majority didn't participate in a virtual work environment. Now many of them are. I would almost argue that they're going to be required to do that in some form just to remain competitive. But the short answer to your question is the likelihood of that. Right now, I would say moderate to low. If all of those factors, high unemployment, economic decline, and this hyperinflation that's happened in a relatively short period of time, if that sustains itself, then we're there. Um, I, the belief is that a lot of it is probably going to work itself out over the next year. So I don't think that that's a primary concern of ours or any of the other folks that we communicate with or follow pretty closely. But it is definitely a consideration. So it's a good question. Um, I wish there was a black and white answer to that, but we're kind of in this gray area again. And I think it really all boils down to the inflation factor. As far as unemployment is concerned, there may be people that leave the workforce and never re-enter. There may be others that can afford to hold out a little bit longer. I think some of the factors that play to that are things like the chart that we showed about savings rates. Many people, instead of spending the stimulus, which was ultimately the design of those programs, a lot of people started saving more money. So maybe you'll find millennials especially have become more selective. They also have a significantly higher savings rate than baby boomers or Gen Xers. And so they may have a greater financial cushion that will allow them to be more selective over time. And so I think a lot, if we're talking about that generation, reentry to the workforce, I believe, is inevitable. Um, but for some, there was a lot of people that were on that the verge of retirement that now are out of the workforce. They made the decision during the pandemic that this is the right time for me. I'm gonna take the leap. Maybe they were more financially prepared for it at that point. Some maybe more than others, but ultimately there's a lot of spots to fill, but there's a lot of people coming into the workforce still, at least skilled workforce when we talk about educated positions. There's a lot of availability. I think there's a pretty large generation coming through, educational institutions right now. We'll see how that matches up. Again, that's kind of predicting the future, but inflation, I think, is probably the most important piece of that. If I were to offer my 2 cents, I think, is it truly transitory or is it here to stay? If we figure that out, or once we get to that point where we figured out what's temporary and what's permanent, we'll have a much clearer picture on what 2022, 3, 4, and beyond is going to look like. And I think fiscal and monetary policy will also reflect what those economic conditions look like as well.
Great, thanks, Ryan. Any other questions? Awesome. If there's no more questions, well, we really appreciate everybody tuning in today for today's quarterly financial update. We will be having our next webinar on November 18th, and it's going to be on long-term care. So November is Long-Term Care Awareness Month. So we're going to be doing it with our partners over at Chesapeake Brokerage, and Evan Roberts will be discussing all things long-term care and what you need to know. We will be sending out that link shortly to register. And if you have any questions in the meantime, just let us know. Have a good one, everybody.